watching Your Money Matters here at NDTV Profit. I'm Mahima Vajrajani. FY26 is now ended and we are stepping into FY27. FY26 overall from an investor perspective has been a volatile year. Now to understand as to what are the common mistakes that investors have done so that you reflect upon them and you don't make the same mistakes in FY27 and to understand all of these things, the market dynamics, the mistakes that you've made, how can you kind of learn from your mistakes. To help us understand that, we're now joined by Prableen Bajpayee, who's the founder and managing partner at FinFix Research and Analytics, joining us now. Prableen, thank you so much for taking all the time. Always a pleasure speaking with you. My first question to you is, what's your biggest takeaway? Because FY26, we saw war, we saw tariffs, all of this impacting markets as a whole. And despite that, when we take a look at India versus global markets, we have been resilient. Though FIs have been selling, there has been a part of DIs which has been compensating for it, right? So just want to understand, what is the biggest takeaway that you have had from an investor perspective with the kind of market performance that we've seen in FY26?
Hi, Mahima. Great to be on your show. Yes, I think it's a great time to, pause and reflect on the last 12 months, especially, and extending, in fact, to 18 months, Mahima, because I think the last 18 months have been rather challenging for Indian investors. And, we've seen, like you've mentioned, we saw some slowdown in growth. We saw a dip in the consumption. We saw the tariff issue. We saw the impact and the worries around AI, the rupee depreciation, and, the final month of the FY26, of course, the war, which has actually just put in so much more volatility, and Nifty in the last 18 months correcting by roughly 15%, and Mahima alone in the month of March, down by roughly 11%. Overall, I think the learnings from this time has been that as an investor and as somebody who manages money is that, there is always pain in the equity markets. That's something we understand, that equity investing is non-linear. It doesn't move up in a linear fashion. And these times when it is non-linear, there can be periods of stagnation, which can be very, very frustrating. And what you really need at that time, Mahima, is I think if your asset allocation is right, that is how you survive these markets. Because you have to have everything in order, in the sense that you cannot be banking upon equity for any of your short-term needs, because there can be pain in equity. So you have to have your allocations to your fixed income, gold allocation and commodities. That is something that I think has been another lesson that you have to. We've always said that there should be something in gold, but I think the performance of gold in this last 1 year has actually proved that there should be allocation to gold. At the same time, we don't start chasing returns. We don't start chasing asset classes which have already performed well. And, if we stand today as we enter 2027 financial year, I think it's really important to firstly applaud the resilience and I think the continued contribution by the investors, retail investors through their SIPs. I think we've absorbed a lot of volatility due to that. And I think the only way forward from here is probably increasing allocations to equity while maintaining your overall asset allocation, because equities at this point definitely look good.
Got it. Prableen, let's take a quick look on FY26. Overall, which categories were relatively resilient than others and why?
Right. So 26, if you see, Mahima, in terms of sectors, let's see, all the diversified funds, which we'll talk about later, of course, sort of gave very meager returns. But in terms of specific sector funds and indices, which really performed well, we saw that metals did great. PSU banks did very well. We saw auto sector perform quite well. Healthcare and pharma was reasonably okay. And what didn't do well, of course, was the rate sensitive sectors. We saw media, we saw reality, we saw IT, of course, due to other reasons as well, of the tariffs and the uncertainty around the whole AI impact. Consumption was quite beaten down. And the whole thing got reflected because if we're looking at the top 5 performers for FY26, we see that, natural resources and new energy, which has a lot of metals in. It has other oil companies. It gave us huge returns of around 23% in a year when Nifty has been down by 5%. This is the fund by DSP. Then SBI Automotive Opportunities, Quant BFSI, which is again the banking sector oriented fund, and also the transportation and logistic funds. But at the same time, Haima, these have given us great performance in FY26. But just to give a perspective to investors that FY25 looked very different because during that year, the top performers were pharma and healthcare. So, we don't chase returns. That's what I think a very big learning is. And of course, you should take sectoral allocations. There's no harm if you have a high risk appetite. But these are just indicative of what has happened in the financial year. And, it should not constitute an investment advice for investors.
Got it. Fair enough. With regards to mutual funds and especially equity mutual funds, how have the major categories in equity mutual fund space performed? I mean, with your analysis, the top, 3 or 5 mutual funds or bottom 3 or 5 mutual funds, and what is the average performance of these mutual funds been like?
Right. So within equities, Mahima, we look at these 6 top categories within equity because these are the categories that we always suggest that you should have a large cap fund, you should have a mid cap or a multi cap fund in the portfolio. And if you're looking at just large caps alone, we see that the category average was negative at 2.39%. The best large cap fund, the returns are 1.62%. And these are times, when a new investor who comes to the market starts saying that probably I was better off in a fixed income fund or a fixed deposit. And that is what we need to understand that, 1 year returns are is not a way that you should be judging any equity scheme. But of course, the worst returns in the large caps was alone 10%. Flexi caps was equally bad by EMA, category average negative 1.3%. Flexi cap, the best fund, has given us 2.6% returns. Mid caps is very interesting. Here I'll mention that the benchmark went up by just about 1.6%. The best performer gave us 12% returns and the worst at negative 12%. But, Mahima, when we just, sort of stretch all of these returns and look at 7-year returns, especially rolling returns, these two worst and best performers in the mid caps, the positions are totally inverse when we are going and looking at 3-year over 7-year period rolling returns. So the short-term performance can be very, very different from how the fund will perform over a longer time period. So if somebody is looking to choose or create a portfolio from here on, fine, you can look at the past 1 year to give, to understand how the fund has performed. But overall, there are many other factors which they should see. And multi-caps, large and mid-cap and small caps were equally, sort of frustrating in terms of returns. They all gave us, a single-digit returns with the best performer barely touching 7 to 8% in all of these categories. So overall, my equity funds, of course, struggled during the whole financial year, and the best performers have also been sub 10% in all of these categories.
Got it. The other big talking point in FY26, Prableen, was gold and silver, right? Both of these metals have done fairly well. Of course, silver has corrected a lot in the last 1 month, but overall still has given, great returns to investors who have, kind of invested in these metals. But from a person who has kept on doing SIPs in these ETFs, what would, a netted return would have, kind of given them in FY26? And now, what would you recommend them to do, going forward in terms of their allocation to these ETFs? Probably see some rebalancing, book some profits. What's the recommendation?
Gold, absolutely glittering all the way. It has been a spectacular year, 60% returns, financial year returns. And, silver is almost double of that, actually. But it's interesting, just to look at the SIP returns. If somebody had started in March of 2018, a simple SIP in gold, and it continued till 2023, the returns would have been roughly 13%. And that's fair. That's what gold has done. Even 10-year returns from 2013 to 2023 are roughly about 11 to 12%. But then if we include these last 2.5 years, the same SIP, which started in 2018 and continues till 2026, has given 24% returns. So I think point number 1 here is that, we have seen a spectacular phase, the rally in gold and silver, but that may not continue going forward. So the past returns, I would say, just omit these 2 recent years and then look at what has been the returns for gold in the past. And that will give you a modest and I think a more realistic estimate of what should be expected from gold. And gold, I think, still remains very relevant for any portfolio with a 5 to 15% allocation even now.
Hmm.
And if somebody is looking to start, I think take a staggered approach, take an SIP route. It definitely should be part of your core portfolio. And I think silver should be part of your, sort of a thematic bet or your satellite portfolio. It shouldn't be part of your core. And I think don't chase the past returns in both of these as on date.
Got it. Got it. Fair enough, Prablin. Now, considering that, the West Asia war still continues, of course, there have been talks that, this might come to an end very soon. But still, that's an overhang as we step into this new financial year. From an investor perspective, what's the best possible manner to position right now in terms of, their mutual fund position, stock position, etc.?
So I think, Maima, if we look at the markets today, there has been so much volatility and which is very discomforting. But if you are looking to take a long-term position, I think these are also the times while we, remain grounded in reality that there is a lot of prices and that can continue. I think still these definitely offer very good long-term opportunities such times. So if you're a long-term equity investor, you're looking for, probably your child's education 15 years away, your own retirement 10, 12 years away, I think definitely relook at your asset allocation. If you are underweight on equity, I think it's time to increase your equity exposure. Don't suddenly jump into mid caps and small caps, but if you're underweight in equity, definitely start looking at equity allocations via diversified mutual funds. Mahima, another lesson I think and a very important thing is, maintain a contingency fund because I think the recent 1 month has also taught us that life is very uncertain. We don't know how global, so many of these factors can impact your own job and your life. So definitely that buffer and contingency fund is really important. And I think take exposure according to your goals and risk appetite. And at this time, if you do have some incremental funds for making a lump sum investment, I think it can be done in tranches. And if your horizon is probably a little closer, 3 to 5 years, then I would say stay more large cap oriented and towards the hybrids. That's how you should be positioning yourself. But long term, definitely a good time, Mahima, to start investing and increase allocation in these markets.
Absolutely, Praveen. Thank you so much for helping us with all those insights. In fact, the important highlight I think that Praveen mentioned was the contingency fund, the emergency fund that everybody talks about, and not a lot of people kind of implement it. 3 to 6 months of what you require for your living should be made as a part of emergency fund and should be kind of be available in liquid funds so that whenever you need it, it's available for you in cash to just kind of use it. Thank you so much, Praveen, for taking out the time and helping us with all of those insights.
Pleasure. Thank you, Mahima.